The mortgage is almost paid off, or maybe it already is. For the first time in 20 years, there's real money sitting in an account that isn't already spoken for. No debt attached to it, no obligation waiting on the other side, just a number that keeps growing. And a question that shows up at midnight, on long commutes, in the middle of conversations about something else entirely. Rental property or the stock market? It sounds like a simple choice. Two options, one decision. And most Gen X people have already made it, confidently, based on what they've seen work for people around them. But here's what almost nobody asks before they decide. Why do the people who chose real estate and the people who chose the market both think they won, even when the numbers tell a completely different story? What is the one cost that landlords almost never calculate, and that changes the entire return when you finally add it in? And why does the option that feels safer at 50 often turn out to be the one that costs the most by 65? The answers are more surprising than most people expect. And for a generation with roughly 15 years left before the finish line, what's in this video could change how that finish line looks. Like, subscribe, and let's start. The napkin number versus the real number. Every rental property conversation starts the same way. Someone pulls out a phone and runs the math. Property costs $400,000. Put down $80,000 as a 20% deposit. Mortgage on the remaining $320,000 at current rates, running between 5.5% and 7.5% across most developed markets, sits around $2,000 to $2,300 a month. Rent the property for $2,600. That's $300 to $600 a month in profit. The phone goes back in the pocket. The decision feels made. And here's where the story quietly changes direction. Because that calculation had numbers on one side, what it never has, what it never shows, is everything on the other side. The costs that don't appear in the headline number, the ones that show up later, month after month, in ways that nobody warned about at the barbecue. Property taxes, council rates, or local levies, whatever they're called where you live, typically run around 1% of the property's value annually. On a $400,000 property, that's $4,000 a year, roughly $333 every single month, leaving the account before a single repair is made. Add landlord insurance at $130 to $180 a month, and that visible monthly profit is already gone. Before anything breaks, before anyone calls. And things always break. Industry data from tens of thousands of tracked maintenance work orders consistently shows that ongoing maintenance for a rental property runs 80 cents to $1.30 per square foot annually. On a typical 1,500 square foot home, that's $1,200 to $1,950 a year in routine maintenance alone. In normal years, not the year the roof decides it's finished. Then there are the costs that every experienced landlord knows about and almost none of them properly reserve for. Roofs last 20 to 25 years. Heating and cooling systems last 15 to 20. Water heaters last 10 to 12. Standard industry guidance says to set aside 5 to 10% of annual rent for these future capital expenditures. On $2,600 monthly rent, that's $1,560 to $3,120 a year. Money sitting in a reserve account, waiting for the day the boiler fails in January. And vacancy. One empty month every 15 to 20 months is realistic in most developed rental markets. On $2,600 rent, that's $1,560 to $2,184 a year in income that simply never arrives. Add it all together, honestly. Property taxes, $4,000. Insurance, $1,800. Maintenance, $1,575. Capital expenditure reserve, $2,340. Vacancy, $1,872. Total annual costs beyond the mortgage, approximately $11,587. Divided by 12, that's $965 every single month in real costs that never made it onto the napkin, never got mentioned in the conversation, never appeared in the numbers someone shared at dinner. That $300 to $600 monthly profit is now a loss. Before a difficult tenant, before an emergency repair,
before the HVAC fails on the hottest week of the year. Landlords who track their costs honestly find that between 35% and 45% of gross rental income disappears before real profit arrives. On $2,600 a month in rent, that's $910 to $1,170 gone every month that the original calculation never accounted for.
This is not an argument against rental property. It has made more Gen X investors wealthy than almost any other asset class. But here's the question that changes everything, and that almost nobody asks before they sign. What the boring option actually builds. Take that same $80,000, the money that finally has no mortgage attached to it, no obligation waiting on the other side. Don't put it into a property. Don't take on a new mortgage. Don't become a landlord. Put it into a broad total market index fund and leave it alone. No property manager to chase. No boiler failing in January. No tenant who disappears owing 3 months of rent and leaves the place needing $4,000 of work before the next viewing. Just a number on a screen that compounds quietly while you get on with your life. Diversified equity markets across developed countries, US, UK, Australia, Canada, have delivered average annual returns of between 7% and 10% in nominal terms over long periods. A 7% average annual return, conservative enough to survive multiple recessions, multiple bear markets, and a global financial crisis, is a benchmark that is held across decades. At 7% annual return, $80,000 invested and left untouched for 15 years grows to approximately $220,000. Zero additional contributions, zero management hours, zero calls at 10 p.m. Now add $500 a month in contributions, roughly what the real carrying costs of that rental property absorb every month, and the 15-year number climbs to approximately $381,000. No leverage, no debt, no single property in a single postcode determining whether the investment works or falls apart. The portfolio doesn't need a new roof. It doesn't have a tenant who knows the eviction process takes 6 months. And every dollar is liquid, accessible within a few business days. The rental property equity is locked until you sell, which takes months, costs 4 to 6% in agent and transaction fees, and happens on the market's terms, not yours. Here's where most people stop and declare a winner. They shouldn't, because rental property has one advantage that the stock market simply cannot replicate, and it's the reason this conversation never gets resolved cleanly. Where rental property actually wins, and what it actually costs. The advantage is leverage, and it's genuinely powerful. That $80,000 deposit controlled a $400,000 asset. A 4% appreciation rate on $400,000 is $16,000 in year one. A 7% return on $80,000 in the stock market is $5,600. The same money producing nearly 3 times the gain because it's controlling 5 times as much asset. At the long-term historical average of 4% annual appreciation, a $400,000 property becomes approximately $720,000 over 15 years. Subtract the remaining mortgage balance of roughly $220,000, and equity sits at approximately $500,000. Built partly on $80,000 of personal capital, and mostly on the bank's money. That is real. That is powerful, and it is the reason rental property keeps winning arguments at dinner tables. But here's the number that changes how powerful it actually looks. That $500,000 in equity didn't arrive free. Behind it sits 15 years of carrying costs. Every repair, every empty month, every rates notice, every emergency that arrived without warning at the worst possible time. When every dollar beyond the initial $80,000 is counted honestly, the total additional cash invested in that property over 15 years runs to $150,000 to $200,000 in most realistic scenarios. Total cash in, up to $280,000. Total equity out, approximately $500,000. Still a meaningful return, but not the story the original calculation told. And then there's the cost that appears in no financial model anywhere. Self-managing landlords spend 5 to 10 hours per month per property. At just 6 hours a month over 15 years, that's more than 1,000 hours, more than 40 full working days spent managing a single investment. The index fund portfolio requires approximately zero.
There is also a risk that rarely gets discussed honestly at the point of purchase. The rental property is a single asset in a single location. If the local economy weakens, if new housing supply enters the market, if regulations tighten, if the neighborhood shifts in the wrong direction, the entire investment absorbs the impact alone. One bad postcode, one policy change, one economic shock in the wrong city. The index fund barely notices. The rental property has nowhere to hide. The real question for Gen X right now. Here's what nobody frames correctly for someone who is 45 to 55 years old in 2026, finally holding money that isn't already committed somewhere. Both strategies can work. Both have made people in this generation genuinely wealthy. The question was never which one is better in theory. The question is which one fits someone with roughly 15 years left. And that changes the calculation entirely. 15 years is enough time for compounding to do significant work in the stock market. But it is not the 30-year runway that makes equity investing almost automatically successful. A serious market downturn in years 12 to 15 creates damage that a 30-year investor could simply wait out. At this stage of life, timing matters in a way it simply didn't at 35. Rental property with a 15-year horizon means actively managing that investment until age 60 to 65. If the property needs a major capital expenditure in years 12 to 14, a new roof at $8,000 to $15,000, a heating system at $5,000 to $10,000, a structural repair that arrives without warning, it lands at exactly the moment when most people want to be simplifying their financial lives. Not dealing with contractors, not managing insurance claims, not finding new tenants. And the market conditions that made rental property look effortlessly profitable through most of the 2010s are not the conditions of 2026. Property markets across most developed countries have cooled significantly since the 2020 to 2022 surge. In many markets, nominal appreciation has returned to its long-term average of 3 to 4%, or dropped below it. The decade of easy property gains is over. The math still works, but it requires more scrutiny than it did 10 years ago. Neither strategy is wrong. The trap isn't picking the wrong one. The trap is picking either one based on what worked for someone else in a different market at a different stage of life, without ever sitting down and running what it actually costs in dollars, in time, and in concentrated risk for the specific situation that exists right now. Gen X learned early that the system changes the rules whenever it wants. They stopped trusting single sources of income because of it. They stopped trusting institutions because of it. They built backup plans and emergency funds and diversified everything because they knew better than to rely on any one thing completely. That same instinct applies here. The rental property that looks like a wealth machine on a napkin might genuinely be one, if the real numbers hold up, if the market cooperates, if the timing works out. The index fund portfolio that feels too passive and too simple might be exactly right for someone 15 years from the finish line who needs liquidity, zero management overhead, and no single postcode deciding whether retirement goes to plan. Or the answer might be both, in a specific combination that matches where the money actually is and what the next 15 years actually require. But the only way to know is to run the full numbers. Not the napkin number, not the number that sounds convincing at a dinner table, the one that includes everything. Because the number that includes everything is the only one that matters. I'll see you in the next video.